All right, guys, welcome back to the Emerald Financial Group podcast. I'm here with Mr. Michael Cornips today.
How you doing?
I'm going well. What about yourself?
Oh, I'm pretty good, actually. Market's been good to me.
Oh, terrific. That's
always a
great
good
to hear.
day.
Yeah, absolutely. Great to hear. Michael is the managing director of Trader Circle and Emerald Financial, but perhaps more importantly, Michael knows a fair bit about the bond space, which happens to be the topic of today's episode. Now, just before we begin, guys, I just want to say that if you enjoy our content, if you watch our videos, please click the subscribe button down below, click like, comment on the video. It actually really helps us out a lot. And, even if you don't like the content, maybe consider doing it anyway, just so that you can be a good person. Mike.
Okay, so I thought what we do today is have a good look at the bond market, especially the US bond market, which is the key driver to the world of the direction of the future of interest rates. So what I'll do is I'll just put up the first slide and just talk to that, and hopefully you can see that. What I've done is, with all the data that comes out from the US government, you can calculate the implied inflation rates that is available in the market for 3 years, for 5 years, 10 years, 20 years. And what I've done is chart that since 2003, just give you a good idea of what inflation looks like over that period, and you can pick up some obvious patterns. And it, I think, is a story of the genesis of what really is occurring today in the market, how the market's developed. I think what happened in 2008, which was fundamentally a credit crash, it was a liquidity crash, and pretty much I think the bond market especially, has changed since then. But let's just talk through it for the moment. If you have got any comments, Sam,
I'll add them in.
Yeah. Just jump on in. So if you look at that chart, you can see that in the early 2000s, inflation slightly picked up. Those lines are all from at the bottom. You can see the 5-year, the 7-year, the 10-year, and 20 and 30-year rates, and they all generally go in pretty much the same direction. But what we're trying to do here is get a visual on the direction of inflation since 2003. So pretty much from 2003 up until 2009, you can see inflation was just downtrending from that 3% level as the US economy was feeling confident, the housing market was expanding, and as we all know, it was expanding a little bit too aggressively, and pretty much what could be described as a credit crunch, liquidity crisis. One day we talk about that in a bit more depth, but so the crash happened at 2008, 2009, and you can see those inflation numbers, expecting the world economy to crash. You can see those inflation numbers going right below zero. But of course, the Federal Reserve invented QE at the time and decided to pump the economy full of money through QE, and the federal government went on a spending binge via the deficit spending. So of course, inflation quickly picked up, and from the 2009 crash, I remember March 2009, the S&P 500 got to that magic number of 666, an unfortunate number, but that was the bottom. But pretty much you can see that from pretty much 2009, 2010, that trend of an inflation really has just come down from that 3% level and really get down to 2017, 2019. That inflation rate's 2%. And as you know, the government only ever talks about getting the inflation rate higher. So through that 10-year period, there was plenty of QE. Monetary policy was loose at the start of the decade, and then they did try and raise rates. But you can see they pretty much got nowhere, and I think most commentators would say that it was we were just in a deflationary stage. And
I I just want to interject there, Mike, that it is interesting that all throughout that period we did have cycles of quantitative easing. We did have extremely low interest rates. So the narrative around monetary policy and loose monetary policy driving or being the predominant driver of inflation, for me, doesn't hold so true. And I think you can look at the US during this period, you can look at Europe for a lot of the same period, and you can look at Japan for the last several decades, and never has that really held true.
Yeah, correct. And a lot of academic study would say that QE actually doesn't lower bond rates. There's actually no correlation there. It actually doesn't create inflation despite the massive spending, as you're alluding to. It never happened in Japan. And but I think as we get into our current last few years, you can see in that 17, 18, 19 period, the Federal Reserve was particularly concerned about the decreasing pace of inflation and not being able to achieve higher inflation. So they went down to 0% interest rates. And the problem with the American economy is that they really can't go below zero, unlike Japan, Germany and the Europeans. They can't go below zero. So, and that's because the US is the world's reserve currency, and the world pretty much saves their wealth in the US treasuries. And the last thing the US needed was their rates to go negative, which would have been a massive rejection from the surplus countries like Germany and of course China. So, and I would say, my opinion, and Sam, interesting to see what you think. I think we know what happened in March 2020, but I do believe we were heading for a recession, a downturn in that 2018-19 period.
Absolutely, and I think if I think probably a bit later we'll talk about the yield curve and the inversions of the yield curve, and the traditional harbingers of or leading indicators of recession were ringing at that time.
Yes, absolutely.
And we did. I mean, US went into recession. They were it was able to be blamed on the COVID situation. Correct. And they're able to engage in significant fiscal stimulus and bring themselves back out of it. Yeah. And
that's exactly right. As you can see from March 2020, you had massive QE and you had several $1 trillion spent by the federal government handing out checks to all and sundry. So you can see that especially in the last few months, you can see those inflationary expectations really picked up. So I'm just going to move to the next slide, which we're just going to have a close look at the last 2 years of this chart you're looking at. We're just going to have a closer look at that to see what's been happening and what's been happening in the market, because you'd have to say, when you Sam, that the market's been for the last 2 years, been fairly bullish.
Yeah, absolutely. One of the strongest rebounds, at least in my lifetime. Yeah, absolutely. So where the narrative that the inflation was transitory, and the US Fed was saying transitory and it wasn't permanent, you can see that period in sort of May to November last year. You can see those inflationary expectations just going sideways. So I want to point out the American bond market, which is a multiple times bigger than the equity market, and I would say that the bond market is generally right and independent of the US Federal Reserve. US Federal Reserve has a lot of control over the short end out to overnight through to 2 or 3 years. But beyond that, I think the bond market tells a lot of truth about what they think is happening to inflation. So the point I'm making is that there was an argument whether inflation was really coming, and as we can see, those bond prices, you can see they just pretty much just held 2.5%, and then you saw the nerves come in towards Christmas, and then we've just seen in the last month the effect really of supply chain disruptions and the inflation kicking in. And the big point is the realisation of the market is holy hell, this is not transitory, this might be real inflation long term,
and there's a lot of implications with that. And obviously, the catalyst of that probably was a Russian.
Absolutely. I mean, I think the last 18 months, probably the biggest driver of inflation has been energy costs, oil costs, and with the Russian invasion of Ukraine, we saw West Texas Intermediate crude spike to about 130 US a barrel, coinciding coincidentally with the most recent peak on this chart.
So there's much talk about, okay, what's Russians' motives and all this, and an explanation, of course, is that NATO has been moving eastward, since the fall of the Berlin Wall. They promised not to move east. They have moved east. There's no excuse for what Russia is doing to Ukraine. But at the end of the day, maybe I read a little bit more into the timing of what Russia is doing. At the end of the day, Russia is an exporter of commodities, and when in March 2020 the oil price went negative, that would have been massively crippling to the Russian economy, who really depended on exporting their oil and their gas. But what happened is that even before the invasion, the oil prices were getting up to that $70, $80, $85. So that price was on the move. And I would suggest that Russia, with all their exports of oil, they were making hundreds of billions of dollars extra profit out of these high commodity prices. And why and I'll ask Sam, why were oil prices going up in late last year and early this year without the Russian war? Is it because of the ESG?
I mean, I'd say that's a fair amount of it. I'd say a lot of oil rigs in the West were turned off around the COVID time. A lot haven't been switched back on. The rig count's still well below what it was pre-COVID in the US. Unconventional oil and gas extraction has been very heavily curtailed. You're seeing a lot less of the fracking, the coal seam gas, that sort of thing. And pipelines and transport mechanisms have been rejected in a lot of places as well.
Because of the green movement. So what happened is strategically, I think that Russia's taken the opportunity where oil and gas prices moved to a very high level, helped by a very constrictive environmental movement that didn't like pipelines, didn't like the Canadian Line 5 pipeline between Canada and America, and Germany's cutting back on nuclear power stations. So we've had high prices, and Russia has seen an opportunity to invade something that they think is strategically important, obviously. But I think what we're starting to see now is a situation of China not sanctioning Russia, India talking to Russia about buying oil at a $35 discount, and even Saudi Arabia talking to Russia. So potentially that was part of the plan, but what we have here, the end result is a massive supply shortage.
Yep, absolutely.
That the rest of the world has to cope with.
Yep, absolutely.
Yep. All right, so then just looking further into the interest rates, if we look at the next slide, and it's the way I think the Federal Reserve looks at interest rates. So,
well, you say look, and I just want to interject and
please.
I mean, look or is forced to look. They are the gentleman in A Clockwork Orange with their eyes held open, being shown
with pickup. Very fun. Absolutely, and I think that movie's been referenced several times. So the way that I think the
and you've drawn it in orange as well.
Well, Clockwork Orange. I must get Malcolm McDowell up there with his evil grin. So the Federal Reserve, even though the current interest rate in the US is about 0.3 or 1%, they nowadays clear very clearly to the market what their interest rate policy is going to be. There is no surprises anymore from the Federal Reserve. If the Federal Reserve surprised the market with a interest rate move in either direction, it would cause havoc. So a lot of pundits, people I read and study, are saying that the 2-year US Treasury rate is actually more reflective of the US Federal Reserve's interest rate policy. Because we all know, and you're reading it in the media, everybody's talking about it, interest rates are going to rise. And that fact is reflected in the 2-year Treasury rate. Mm-hmm. So what I've done with this chart is I've charted the 2-year Treasury rate, which you can see is really spiked up, close to that, getting towards that 3%. And you can see that little hiccup in the blue is the 0.25% increase the Federal Reserve just did. But the expectations policy is that cash rates are going to 2.5% to 3%. But you'd be the first to say that possibly, even though the market is saying this, and you can put a bet against that and make some money if it doesn't happen, you can put a bet on the futures market, but you're saying that it's unlikely that there's a chance it can't happen.
Yep, absolutely. I do want to quickly, before I go on to that, I do want to say that yes, the Federal Reserve does definitely signal well in advance what their policy moves will be. They even helpfully provide a dot plot of where their members see future interest rates. What I suspect has increased, at least since the GFC, what I suspect has more happened is they've just decided to do what the market wants them to do or expects them to do. So you'll never get them come out and do anything different to what the market expects, really. And I think they've figured it out. The market will basically tell us what policy should be moving forwards. And I think that's been a noticeable shift in the way they've acted. And where it does matter is situations like now. Moving on to what you were trying to say is, I don't think what we're seeing is monetary policy driven inflation. I don't think, oil prices are at 100 US a barrel because interest rates are zero. I don't think, we're about to see we have seen a big spike in used cars because interest rates are zero. I mean, possibly people are borrowing to buy used cars, but more likely, you can't get new cars. Oil is in shortage.
Yeah. I would agree with that. What you're saying in effect is, Milton Friedman always said that inflation is always and everywhere a monetary phenomenon. So in what the way Sam said it was, it's not because there's monetary inflation out there. There's this huge demand. What's really happening is this massive supply constraint coming out of supply chain disruptions, the war, the COVID-19 created these supply chains. So the common comment, and it's not an unreasonable comment to make, is, well, if we put interest rates up to 5%, how is that going to solve our supply problems?
Well, exactly.
That's a fair point, isn't it?
Absolutely. And I think on the other side of the coin, there is a lot of money out there. Mm-hmm. You've had huge government deficits in Western nations across the last few years. And really, we're getting all this commentary that we need tighter monetary policy, we need to rein in monetary policy. But you're not hearing many people saying, well, perhaps this huge fiscal spending could be influencing these price gains that we're seeing. We're not hearing that Joe Biden should perhaps lower the deficit slightly, but
so then the next logical point to take it forward is that there's two scenarios playing out here. Interest rates, mortgage rates in New Zealand, for example, I think are about 6% at the moment, which would scare anybody in Australia. But and the 30-year fixed mortgage in the US, because they can borrow at a 30-year fixed, is nearly 5%, 4.9% last night. So the consumer is getting hurt by higher interest rates now. Australia, not so much. But so there's two scenarios I think Sam points to. One is there's going to be high inflation and interest rates will go higher. The other coin, I think what you're saying is the government can't afford to lift interest rate. And I think you make that point when you reference that the Fed what the Fed does do is market surveys, and a very good a podcast on the web, and you can go to his website, a guy called fedguy.com, a guy who used to work on the funding desk of the Federal Reserve, and he says when he was on the money desk of the Federal Reserve, they constantly did surveys of market participants and said, what do you think this means? What are the expectations? What are your interpretations? So going to Sam's point, that's exactly what they do. They know what the market expects. And just to tease out your comment a little bit further, I think you're right. I think that's how they're managing it. What does the market want? And they're giving it to them. But then something bad's going to happen in the future where the unemployment rate goes up, trade deficit, something bad happens, and then I think you're saying is they'll have an excuse not to do it.
Mm-hmm. Absolutely. I think eventually they will. And it's going to be very interesting to see how this situation plays out in the next sort of 12 to 18 months as they do start lifting interest rates. And already we've seen, I think, and I think you're about to bring it up, but an expected, we've seen a yield curve inversion basically after about 2 to 3 years, suggesting that, yes, the market thinks interest rates will go up, but they also aren't convinced that that's going to be a good longer-term thing for the economy.
And I think you're absolutely right. So we just moved on to the next slide, and what I've done there is over the period I've drawn. So a yield curve is normally upward sloping. A healthy economy is where the 10-year rate is higher than the 3-month rate, is higher than the 1, 2, 3, 5-year rate. So a normal curve is where the longer-term rates are higher than the shorter-term rates. Now, when they say there's a yield curve inversion, as what the graph is trying to do, is that when the 10-year rate, when the 5-year rate goes below, 5-year rate goes above the 10-year rate, that means they expect the economy this economy is going to slow down in the future. So what I've done there is taken the 3-month rate, the 2-year rate, and the 5-year rate, and the 7-year rate, and looked at that as a difference between what the 10-year rate's saying. So what happens is, as you can see in 2008, when all the curves went to zero, so all the interest rates were the same, you know how much trouble that caused the economy, and the economy was in recession. So then we got the stimulus, and when all those lines go back to normal, that means all the rates are in the long term are higher than the shorter rates. But now we've seen in COVID time, it went negative. It went below. All the lines went below, and that was definitely a scare of recession. We obviously have had the recovery in the last 18 months, pump priming the economy, and look what's happening now. And you'll be hearing commentary from, whether it's from the internet or whether it's from the news, is now rates are not really super inverted, but you can see it's not a lot different to 2008-9, and not that much different from 2020. And as they say, all recessions are preceded by an inverse yield curve. But on the other side, all inverse yield curves don't always produce a recession. So what we're saying is that there's very high odds that our economy is moving in a recession. The reason that blue line is still high is because rates are 0.3, but as soon as the 0.3 rate goes up to nearly 3%, it'll be the cash rate will be higher than the 10-year rate, so that will invert as well.
Mm-hmm. Absolutely. And I think just adding to this, there are actually comments from Jeremy Grantham today, he'll be right eventually, that a lot of recessions are preceded by big spikes in the oil price and big spikes in energy costs. And, you know, that's what we're seeing at the moment. We've seen the yield curve inversion. Not great signs for the medium to longer term of Western economies.
I think a lot of people would say that most crises are caused by commodity price blowout. So, and you may recall the oil price going to what, $130, $150.
Yeah, well, not that long ago.
Not that long ago. I remember Rio got to $150. Same time I think BHP was trying to do a takeover. So the general point is that the interest rate, the bond market is telling us inflation's coming. Interest rates are going to go up. Fair chance the government can't put interest rates up, but if they can't put interest rates up and inflation's still 7%, that means you've got stagflation.
Yep.
And what does stagflation mean for the average person? Well, if prices are going up 7% and your wages are going up 2%, your wage is going backwards.
You're becoming poorer.
You're becoming poorer. And as all the items in the CPI, Consumer Price Index, rise, that will squeeze the average person's take-home pay. He's also facing mortgage payment increases on his mortgage. Rental vacancies at the moment, except for Melbourne and Sydney, the rental vacancies about 1% nationwide, so there's a rental squeeze on in the market. And Melbourne, Sydney rental vacancy rates are down to about 1.5% too. So there's a mortgage payment spike coming, there's a rental monthly rental spike coming. So the economy is not looking really good, and I think, you know, are you surprised, Sammy, that the RBA doesn't put its interest rate up?
I'm a little bit surprised, but I think there's a few reasons they're going to wait, predominantly because of the federal election coming up, and they.
But that's political. You know what? You're not saying our Reserve Bank's a political entity.
It was Bernie Fraser who lifted interest rates on Howard going into an election and got roundly criticised for it.
So he's too scared to.
Yeah, absolutely. I mean, our RBA, you know, requires a bit of a universal alignment to make a single word of change in their statement.
Correct.
They're not going to do anything until after the election. May 14, by the way. Save the date. Don't go out of state. And but to be fair to the RBA, our headline and core inflation data does lag the rest of the world. Our prices aren't going up as quickly as they are overseas.
Yeah.
So.
If you look at the Australian bond futures market, it pretty much says that you expect a 0.25% in May or June, and every 3 months after that, expect a 0.25% rise. It's pretty much what the market's saying. But having said that, even though we're lagging the rest of the world at the moment, New Zealand's I think is 0.75, UK is up, Canada's up. Even though we're lagging at the moment, we're predicted to overtake, according to the interest rate markets. We're predicted to go higher within about 12 months to go over the rest of the rates as a sort of possibly a catch-up mechanism. Mm-hmm. So moving on, just having a close look. The other thing you can do with the bond market, the way we analyse it, is that we can look at what the bond rates are 5 years from now. Just some simple mathematics. And in fairness, I don't think that looks too bad. So this is the bond rates going back to the beginning of 2021, and there's no great spike there, I don't think. So in 5 years' time, and what that's saying to me, because that looks fairly calm, what that's saying to me is that if you want to use the word transitory and say 3 years instead of transitory 3 months, I would say people think the damage is definitely going to get done over the next 3 years, but after that they're expecting, and that's what the market's telling. I think they're saying, well, bond rates will be 2.5%, and I genuinely think we'll be able to live with it.
Yep, absolutely. It's suggesting really for some time we've expected them to peak 2.5%, 3%, somewhere in that range.
That's right. And then the last slide, I just sort of, and there's been a lot of commentary in the market about what happens to mortgage payments if interest rates go up. So I've just got a slide up there. The panel on the left is from CanStar, which says that the average mortgage rate at the moment is about 2.99%, plus or minus, depending whether you're a new customer or whether you're an old customer.
It pays to change, by the way, guys.
Pays to change.
You get rewarded for disloyalty. So
exactly right. So what I've tried to do with the right-hand panel is that if I just took a $500,000 mortgage and I applied the increasing interest rates to a $500,000 mortgage over 30-year principal and interest, and what do we see? Well, pretty much mortgage payments go up by 40% over the next 18 months. So that's obviously quite a big number. And I'd also make a point with that if mortgage rates, so if the cash rate goes to 2.5%, your mortgage rate's going to be close to 5%. But then when you go and apply for a mortgage, they have to put a buffer onto that interest rate, don't they, Sam?
They certainly do, yes.
You have to put a buffer onto that rate, so you have to get tested at 7 or 8% interest rate to see if you can afford the mortgage. So I think I see some quite good information on the internet. Martin North from Walk the World, he does a lot of analytics on mortgage stress around the country. He does very comprehensive surveys, and he can tell you postcode by postcode who's got mortgage stress, who hasn't. It's not one number. Australia is a myriad of separate postcodes, so I think you'll see a lot of pain being expressed in different parts of the country, whether it's Ryde or whether it's the outer suburbs of Melbourne.
Absolutely. And yeah, you're right. You know, it's going to be a lot harder to get a loan at higher interest rates because of that buffer. And so not only will people will be facing potential mortgage stress, but the potential purchases of their property, if they have to sell, are a lot fewer because people won't be able to get loans, or they won't be able to borrow as much.
Yeah, and the problem is, of course, is that Australia, instead of being a proud manufacturing country, we're pretty much a property country.
And
we are a company.
And a mine.
And a mine. We're houses and holes,
yep,
as people say. So I don't think a lot of people are happy with the amount of effort the government goes to keep housing prices high. We all will talk our book as older generation, generally as homeowners. We'll all go, we love high house prices. And because there are more homeowners that vote, I think that's with statistics, than people who don't own homes, you know what the government's going to do. It's going to, nowadays you can get the first home buyers grant. You get 25% deposit is available by the state government. Now, some people we know have taken 25% of the home price from the government to get paid back in the future sometimes. The amount of effort the government goes to keep home prices high is I think terrible, and I think if a scenario plays out where mortgage rates go to 5 or 6%, I would like to see the accountability back to the people who actually caused this scenario, but of course by then we'll have a change of government and nobody will be the wiser.
Well, absolutely, and it will be, it is an interesting move with bottoming rate cycle, that one of the policies is essentially to push prices up further with huge buyer support.
Yeah, we had a Royal Commission, few suggestions, but that's all they were.
Well, exactly,
Our thoughts and prayers are with you.
Yeah.
Sammy, what about maybe talking a few minutes about the commodity prices?
Yep.
And implications coming out of this economy?
Absolutely. So I guess when looking at the bond cycle and interest rate movements, and then the effect on the wider economy and the effect on the business cycle, you're looking at the changes in value and yield on money, but there are alternatives to fiat currency. One that we discuss an awful lot is gold, and one that we discuss less frequently, which you don't agree is an alternative to money, is cryptocurrency.
Well, I do a lot of reading about, and the question to ask is, well, what is money? So a study done quite a long time ago, I think over 100 years. What is money? Money is, there's three good attributes about money. One is the store of value. One is something that you can transact. And what was the other one?
It's a ledger item, basically.
So the question is crypto a store of value? Well, something that goes from 10,000 to 65,000 to 45,000, that is not a satisfactory stable. You can't save in crypto. Not saying you shouldn't put money into it, not saying you shouldn't put 5 or 10%, whatever you deem appropriate. But if you're looking for money replacement, I don't think it is a good store of value.
No, and that's fair enough. And I do just want to seize on that point is I think the legitimacy of crypto has increased a lot over the last couple of years purely due to price performance. We've seen Bitcoin rally from $8,000 to $60,000. And that rally, that price performance, that gain in value, a lot of people have pointed to that and said this is legitimate because it's gone back up. It's exceeded the 2017 peak. There's value here. This is a real thing. But you could have bought calls on Tesla over that period, over a 3-year period, and it would still be a
but you have to
a risky proposition.
You have to rule for all the people, not just the people who can save money and buy crypto. So what you need money to do is that if it's going to be money, you need to be able to borrow money. And I would ask you, would you borrow in Bitcoin? And if you say, well, El Salvador is, well, they're actually going to borrow in Bitcoin and they're going to mine Bitcoin to pay it back. So they're not really exposed to the Bitcoin price, I don't think. But would you borrow in Bitcoin? And I would say you probably wouldn't. And I think people conflate price performance as an attribute of money, and it's not.
Well, yeah, and that was my point. Price success or an increase in value does not create legitimacy.
Okay, so
I was agreeing with you on that. Okay. Like I was saying, you could buy a call option on Tesla and go up, over that period and go up extreme amounts in value. It doesn't make it any more legitimate than a call option.
So we talked about store of value. The other attribute of money is unit of account. Now, I can't see anybody saying, my house is worth, they'll say my house is worth $2 million. I don't see anybody saying my house is worth 300 Bitcoin.
No, they don't. And I think, again, it's a volatility story. There's just too much volatility in the crypto space to compare it to non-crypto assets.
And of course, is it a unit of trading, unit of transaction? And the big criticism I hear of Bitcoin especially is that it's not, you can buy crypto, you can take US dollars, Australian dollars, and you can buy Bitcoin. But you try and take the money out, it's going to be a lot harder because 80% of Bitcoin go through the Tether stablecoin, yeah?
Yep.
And the problem is that Tether claims to have 82 billion in US dollars backing the Tether issue.
Not anymore. They've admitted they were lying about that, but yes.
But they're saying that they've got they've admitted to not owning US treasuries.
Yep.
And they've said we've got other assets.
Yes.
But they only admitted that under pressure.
Yep.
Because of several audits that everybody wants to have. So the point is that if 80% of Bitcoin is actually done through Tether, that means you get somebody. If somebody's just printing Tether like paper, you can support the Bitcoin price. But if you want to take out 10 or 20 billion, it has to come back through Tether to do it, to facilitate. Would you agree?
Well, I mean, that's obviously the easiest or most convenient way of doing it. Otherwise, there's an awful lot of work involved. Absolutely.
And there goes the point. But anyway, this was not trying to say I think Bitcoin is bad. I'm a big believer in blockchain and the utility of blockchain.
And all the problems you've mentioned, there are people, very, very intelligent, very, very capable people working on changing, be it through stable coins, be it through more efficient systems.
Having studied the monetary system over the last few hundred years, and especially in the Americas in the 17 and 1800s, a lot of smart people did make a lot of attempts at a monetary standard. The US got into a bit of a mess with every state issuing and every bank issuing their own coinage. But in any case, I do believe the technology is brilliant, and NFTs, smart contracts, definitely the thing of the future. I think the people focus on the price appreciation.
Absolutely.
Maybe that's my main point. Just moving on to the gold commodity space, I think what's happening is that I don't think the US or the Europeans are that strong in the current argument with the Russians. They pretty much opened the door to Russia is now pricing its oil in rubles or gold. They have a standing order to buy 5,000 grams, 1 gram of gold for 5,000 rubles, which equates to about $1,900 an ounce of gold. So the Russians have pretty much said, we'll buy as much gold as you want to sell us at 1,900 US. The US unfortunately sees their US dollar reserves, and as much as Russia may have deserved that for their atrocious actions, the problem is it means that America has and always has confiscated US treasuries if they didn't like that country. So people are saying, well, how safe are my US treasuries if the US can confiscate if they're unhappy with me? And as we know, whether it's Syria or Libya or all those sort of countries, they've had the US dollars confiscated. So now Russia's saying because they sanctioned the Russian banks, you can't pay euro or US dollars predominantly for their oil. So the Russia said, well, pay us in rubles. I think last night in Bloomberg, Russia made a payment on its bonds, US dollar bonds. They made a payment in rubles. Now, they didn't have a choice because they didn't have the US dollars to pay anybody because they're cut out of the system. But I think what this is doing, it's created an opportunity that people are focusing on the weakness of the US dollar. Mm-hmm. US dollar can be unfair. It uses that as a leverage and power. China, as I mentioned earlier, China is negotiating with Saudi Arabia to buy oil for Chinese yuan. Russian will sell oil for ruble or gold, and India is ignoring international sanctions. So I think what's opened up is a crack in the strength of the US dollar, and I think people are interpreting that as, right, well, what are the alternatives? And my belief, the only hard money alternative is gold, silver, or some other commodities.
Absolutely, other commodities. And I think, if you believe in the inflation story, and inflation is high, what is driving it? It's high commodities prices. And if interest rates top out at a few percent, well, it's not that significant to dent the sentiment around gold, and it's not that significant to dent the desire to own other, hard resources, other hard commodities.
And I think as a money manager, the percentage of funds into gold is only half of 1%. It used to be 5% back in the day. I think going from 0.5% to 5% allocation would be about $20 trillion. So now we've all been waiting for gold to break out, let's be honest, and there have been many false starts. Mm-hmm. And any ramp up to 2060 has always been met with disappointment.
Well, yeah, absolutely. And, I think it's a low volatility asset, and so huge breakouts very unlikely in the short term, but it is extremely rare. Over time, it's gradually appreciated, not necessarily ahead of other assets, but in general, it has appreciated, and it's been a store of value for humans for probably tens of thousands of years. No fiat currency has lasted more than a couple of hundred. So
correct. And gold since the year 2000 has done 10% per year, but that's when it was 250 up until now. You couldn't quote the same number for the last 10 years. But at the end of the day, it has held its value. It hasn't gone down 70%, and hasn't gone down to zero like oil. So,
and if you're watching, what the US did to the Russian US dollar reserves, well, all the more reason you'd probably start thinking about gold a little bit more.
And I think the world is so. I'm seeing, to me, I'm seeing China, India, Russia, all talking to each other about what about now. I've had a good look at the gold holdings that the Gold Council puts out, and it was clear to me that all the Western countries were depleting their gold reserves, and that's Canada's got no reserves. Australia's got, I think, $6 billion of gold, which is not really much. The US dollar has been carrying, a few ton of gold on its balance sheet, still values it at $42, would you believe? So it doesn't add to its gold. So the Western countries sold their gold, and clearly the Eastern countries have been accumulating, and they're saying that there's probably the governments disclose their gold. China, Russia disclose their gold holdings, but some people are saying there's some hidden gold in their sovereign wealth funds that would be multiple times of their government holdings. So I think we are seeing a potential breakdown of the US dollar. Shouldn't say that too quickly. It's been said before, but I think in this environment where we know America can't afford what it's doing, it's only doing it because it's the world reserve currency. It's got that privilege. If it had to actually pay and balance its books, this story would be over.
Yep. Oh, absolutely. Absolutely. So it's an interesting world we live in. It's going to be an interesting 3 years, I think.
Yeah, I think that's how we'll be. How we talk. We focus on a lot of the commodity stories.
We do.
Value today. I heard you talking this morning on the podcast to Fortescue being
Fortescue Metals. We're big fans of Fortescue Metals here at Emerald Financial. It's been one of our recommendations for a long period of time.
Aeris looks quite good.
Aeris Resources, absolutely. And I think going into a higher rate environment, you want to look for the value stocks. You want to look for stocks producing, hard commodities. That we're fortunate here in Australia that we've got some of the best companies for this on earth. And I think a lot of the time they get a raw deal. You get a lot of people out there who want to buy a pipe dream stock trading on 200 times earnings, that'll never earn your investment back for you. And we've got stocks here that trade on 5, 10 times their earnings, who can pay you back in a few years. And
so, as we all know, there's two main types of mining companies. They're explorers, and they're the producers. The producers have been very conservative in their capital management.
Yep.
Probably haven't done as much exploration. They've had capital headwinds because of the ECG movements. It's very hard to raise capital. So their opportunity in mining, I tend to avoid the speckies because I probably can't understand the technicalities of that too much. I can understand reserves and production and doing capital management. And I think just on touching on that point, another reason oil prices I think will rise is that because of the environmental movement, a lot of cost of capital is too high, and the energy companies have moved to capital management, share buybacks, big dividends, and a lot of their exploration has tailed off. And as much as they say that like the oil companies, the well's not completed. That's a figure they follow. That is that the reserve of drilled wells not completed, the reserve of those is going down, and the problem is that when they run out of those of wells, where if they haven't done the exploration, we have got another supply constraint on us.
Absolutely, and that's not just a short-term thing. That's something we could witness play out over the next decade. So
that's right.
All right.
Okay, Sam. Well, that was a good run through interest rates and
absolutely.
what can potentially happen. I think we monitor the interest rates closely. You get a lot of market signals. I get a lot of early signals as to what's happening.
Mm-hmm.
I did own a fixed interest. Help me. The Australian Unity's got a stock that issued at $100, pays 7.15 yield. It got to $108. I got concerned about rising bond rates because rising bond rates hurts fixed rate yields. And today, that $108 today is trading at about $98.50, 10% off. So it does help you trade those fixed interest type stocks. So I think it can create opportunities. I remember National Bank issuing a very similar security to the Australian Unity, NABHA, paid a fixed return in perpetuity. I think it went down from $100 down to like $40 or $60. They eventually paid it out at par at $100, but those fixed interest securities can really hurt. So anyway, that's something we'll be watching closely and hopefully can pass on to you guys.
Absolutely. All right. We might wrap it up there then. So look, if you've made it this far, guys, that obviously means you found something interesting or useful, or perhaps you had your hands full while this was playing on the TV in the background. But at the very least, if you have been occupied by our video, please go down to the comments, let us know. Let us know anything you'd like to hear us talk about. Maybe give us a thumbs up for a like, click on the subscribe button, and we'll hopefully see you in the next one.
And see you next time.
Thanks, guys. Bye for now.
Cheers.